Hey everybody, this is DayTraderRockStar, and this is an educational video, stock trading for kids, students, and beginners, part 4, moving averages. Now this comes after we've already put out 3 videos, introduction to stock charts and trading. That was part 1, trend lines and support and resistance. Part 2 was channels, and part 3 were rising and falling wedges. I kind of jumped up there with the part 3. This one should have been part 3, could have come a little bit before that, moving averages. I've been a lot of people asking me to do a video on that, and I'm taking the time to do it today. So it is a very basic video on moving averages and some of the thoughts on what the moving averages do in my type of trading, and how you could use them to make money. So first of all, moving average, a basic definition of a moving average. It's a trend following indicator where we basically when we break down a moving average, we call it a period moving average. So whatever time frame we're working with, say you want a 20-day moving average, what the moving average is going to do is take the last 20 days of data, add it together, divide it by 20, and plot that line as the average. So it's a 20 period or 20-day moving average, which we have on right now. So the price here could be away from the price. The moving average could be away from the price. It could be right on the price. It really depends. But what it really is acting to do, what this indicator is doing, is kind of smoothing the whole process. And moving averages are a trend indicator. I mean, we try to identify what type of trend the market has. Is it a bullish trend or a bearish trend? And lots of times we'll see that the price trading and relative to where the moving average is will determine or kind of classify where that trend is. So in this case, we're trading above the 20-period moving average, and that in some cases could be as a short-term trend higher, versus if we break down underneath it and we start moving back down and we hold underneath it, you could actually say the short-term trend is down until we break them back above it, and you could actually see us trading of it. Same thing, short-term trend higher, back below it, short-term trend lower. So it's a trend identifier. You calculate it again by taking how many periods you're trying. If you wanted a 50-period or 50-day moving average, you go and take the 50 days, the past 50 days, you add them up, you divide them by 50, and it plots it on the point. And each day you continue to add to that, and that gets plotted, and that plot actually becomes that moving average, and you can actually feel that. So right now I have the 20-period moving average there, and the most common moving averages are the 20, 50, and 200. You'll read a lot of some people. They might use 17-period moving average. They could use 9-period moving average, 100-period moving average. And remember, I'm saying period, so to overhang, don't get confused by saying, what's the moving average? Is it always on the daily? Is it on the 5-minute? Well, when we say period, it just overlaps all the time frames. So if you're talking about a 20-period moving average, the 20-period moving average on a 5-minute chart will take the 5-minute candles, the last 25-minute candles, add them up, all right, closing prices of each of those candles, divide by 20, and it plots that line on the 5-minute moving average. And that's how that works. And the same thing for any other time frame, weekly, monthly, same thing. So the more important ones, again, is the 20, 50, and 200-period moving average. I have the 20 on there now. I'll show you the 50. I made it a little darker. The 50, as you can see, is that blue one. And as you go back further, the movement of the moving average won't be as volatile. It'll be less. It'll be smoother. If the smaller the moving average, say it's a 5-period moving average or a 10-period moving average, it'll stay in line with the price. Where the farther you go out, and we went out to the 50, now we'll go out to the 200-period moving average, which will be in red. And you can see this one is pretty much just a flat line, and it takes a while for it to really start to move and stuff. So these are all based, and you could tell that the 200-period moving average here is slightly down, a little bit lower. The price is now above it, and we're definitely above the 20, 50, and 200-period moving averages. Now, the way you use these moving averages, some people use them as support and resistance, meaning that if the price moves up to a moving average, we could look for a reaction off of that. If the price comes down to a moving average, we could look for a reaction on that moving average, back here. It really depends on how you want to pay attention to it. Do not use my moving averages like that. I just find that it's, even though the bigger qualified companies that we follow, the best of breed, tend to work better with the moving averages, like Apple and stuff. You'll still see that it's not like a brick wall here or a line in the sand. The price will chop around that moving average. It's very hard to hold that moving average as a key level of resistance or a key level of support. We'll chop around it, break higher, come back to it, drop down. Some cases will come back up to the 50. Some cases will hold the 20. Some cases will hit double bottom. Some cases will break back up and open up at the 200. I just think, back in the day when moving averages were more of the, book reading material you would get, it tend to hold up more in trading. But right now there's other things at play, and we follow other indicators that tend to work better than the moving averages. But I keep the moving averages on my chart. I think it's important to see, just keeping them there. Lots of times we might get a trend line and a moving average combined, where we have a recognizable channel, which was an earlier video. And that channel line comes underneath, and it actually represents also a moving average level. So the combination of two indicators might add to a decision-making process there, when you come to that. But, I wanted to give you, some better information on the moving averages. And, honestly, I could tell you, be careful from, they don't hold the strength they used to hold in the markets. Any other things we could talk about on moving averages? I do use them as one of my indicators, and I like to just concentrate on certain techniques with the moving average. So I'll give you a couple of my favorite techniques that I use with the moving average. Sometimes when we scalp the market or use a short time frame, say the 5-minute time frame, I like the 5-minute and the 200 period moving average together. I find that time frame and the 200 work out good, especially if there's a quick move down or a gap up or a gap down. A fast move to 200 sometimes shows, let's bring up a random stock like Home Depot. And you can see this is the 5-minute time frame. You can actually see here we actually came up to the 200, and it's chopping around it. Again, you don't want to use that as an absolute value, because 136.32, you could say that might be the moving average, but we actually moved up here to a dollar higher. It's just not the type of trade I want, but I also want to respect it and understand that the trend is intact. The last time we might have came up to that level, you got rejected from it, so I'll follow it. If I see that happen, and we go back there, and I say, oh, we're back up above that level, we're popping through, it might react. And we might react because our stochastics are overbought, and we're at the 200 period moving average. Stochastics overbought at the 200 period moving average, and maybe we can start adding our indicators up and seeing that we have a better shot of a pullback versus a pullback being oversold and at the 200 period moving average, which we don't have on that right now. But for whatever reason, we end up getting up here and then pulling back and holding above the 200 period moving average and being oversold. That becomes a short-term buy signal for us. So that's using the 5-minute time frame. Now I always keep the 1 minute, the 50, and other ones, and it's about just kind of hitting it. Let's take a look at Apple. Maybe it's not Apple. It's not really showing you that type of action against the 200. We chop around it. INTC, just here we have, again, a lot of chop, especially the last few days. The market has been very choppy. So on the 5-minute time frame, you're not picking up anything off of that moving average. The daily, not really picking up much off of that moving average. The 20 period moving average is another important one. Another technique I use is just paying attention to the stochastic oscillator as it rotates back down. And we'll probably be discussing this more. I actually specialize in trading the stochastics and using those with moving averages, or using those with a relative strength. So we would watch this 20 period moving average and see how the price is holding us. We'd see how the stochastics are rotating back down, and as we get closer and closer to oversold level, we hold on to that 20. It's a very bullish setup. So I tend to watch that retracement. We watch some of the retracements and that 20 period moving average here. A couple other stocks here might be familiar with. We'll just take a couple. I don't even know what they look like. Walmart, same thing. Not much going on here. We're chopping around the 20, back down to the 50, popped, back down. That's on the daily, the 5-minute time frame. You can see we kind of held on to the 50-period moving average, then dropped back down, and it chopped around and started holding under the 20 and really holding that trend. So, you know, the best thing we could say about the moving average is it's definitely a trend indicator. Once you establish that trend on the, you know, a very strong trend, and you see that market push up to the 20 and push back down, push up to the 20 and push back down, you know, you might be able to take a trade off of that. And the same thing on the opposite side. If we start to move up, we hold that 20-period moving average, and you know, you might want to take a look at a trade like that. So 50, well actually, 20-period, 50-period, 200-period moving averages. One last note on the moving averages. There's two types that you'll constantly hear about: the exponential moving average and the simple moving average. I tend to use the exponential moving average, which adds a little bit. It's a little faster. It's not as smooth. It's a little faster. There's a little bit more weight added to the latest data, and it's usually calculated inside most charting programs. So I won't go into the calculation with you, but just to let you know, so you don't, there's no confusion. But you know, the difference between the exponential and the simple is very small. I do like the exponential, the little faster average. I tend to think that it gives me better signals, but you could use. And also there's other time frames that people recommend, like the exponential. You talk about the 26 period or 26 day on the daily versus the 20. But if you really look at that, and I adjust that, you watch that green line here, and I want to adjust that to the 26. You'll see that slowly it adjusts a little, but not much to where you're really seeing much of a big difference there, you know. And like I said, these things are not a strict brick wall, line in the sand on support and resistance. And the area to watch, usually to combine with something else. And it's also very important to understand that your trend is identified by that moving average. So the short-term trend indicators on the shorter moving averages, the longer-term moving averages give us the bigger picture. And that's how we really use these. So the moving average is important, but definitely not on the top of the list of really, you know, pointing out a place to make money in this market. Hope you enjoyed that video. That was part 4. I know we got a lot more coming up. I'm probably going to do, I also have a very good course on stochastics, which is really the basic and foundation of my trading. And you'll be hearing more about that soon. All right, we'll see you in the markets.